Hello and welcome to the Plain English Finance Podcast, the podcast dedicated to helping you make smart financial decisions. I'm your host, Trey Bino. I'm a financial planner with TCU Wealth Management and Aviso Wealth. For more details or to send in your questions, check out the show notes at treybino.ca/podcast. So this episode is a special episode, I guess. I'll be doing these every once in a while with various things. I do quarterly reviews for my clients, and this is my first podcasty quarterly review. So we're going to kind of go through what I went through kind of in the video that I put together, and you can ask questions and maybe it would answer some questions that other people have. There are a few items I wanted to go a little bit more into detail into about it, and yeah, kind of go from there. So this is actually this is the first time I actually sent out this podcast to my clients. So
hello, clients.
yeah. Welcome, I guess.
Yeah.
So first off, something I didn't even mention in the video was we saw the massive drop. Well, I say massive, it was, below 20% for the US drop that we saw in the very beginning of April. That was fun for a lot of people. It actually speaks to the timing of when, if you didn't know that happened, you would have no idea. You'd have just got your statements for the second quarter and wouldn't have noticed anything because the statements were ended at the end of March. So it had been fine. It was beginning of April, the drop happened. Everybody panicked. Markets came back up. Markets recovered. If you'd have just seen those two numbers, end of March and end of this second quarter, you would have, markets are up. Wouldn't have known it happened, which is kind of a funny thing that, yeah, it's a lot scary when you watch it go through it. If you go through it, if you see the numbers and you see it go through the ups and the downs, it's a lot scarier than, just taking a snapshot every once in a while.
Yeah, for sure.
So it's actually funny because a lot of people would think, oh, I have a low risk tolerance, not realizing that they've been through some quite significant ups and downs.
I don't know whether that's a good thing or not.
I don't know. It's one of those. It's always something that I weigh the pros and cons with. Like I like to send out like an email or something like that, so clients hear from me. But at the same time, I'm like, if they didn't know it happened, then maybe they'd be better off not knowing, right? And maybe hearing from me makes them go and check, and then that scares them.
It's like ignorance is bliss.
Yeah, to a degree. But I've made the decision that no, I'm gonna send it out regardless. I think it's more important that if it is something that we should be doing, that you hear it from me. So
yeah,
for sure. But yeah, so we got through that. The biggest themes have been the trade wars. So
is that the tariffs?
Yeah, the tariffs. So we saw the US and Canada and the rest of the world have this fight over trade. We've seen, Donald Trump yo-yo on tariffs that he's going to put on. Sometimes, they go up and down, and then somewhere in the middle is what actually gets implemented. People are currently holding their breath for August 1st, I think is his latest deadline of more tariffs. They're actively pursuing deals. The funny thing is, I feel like at the beginning, people, or the market, should I say, jumped more when he would say something. And now everyone's just like, let's just wait and see what happens. Don't do nothing don't do anything until it's actually implemented. So I do think that means that if, markets move with things that are surprising, it feels like anything is going to be a surprise. So who knows? But yeah. Anyway, and something I did want to go through. Actually, I'll tell you what the returns kind of were for the time period. I know it really interests you. So year to date, Canada is up 10%, which is actually surprising for a lot of people, me included. I thought that Canada would be hit. I thought it would take a lot longer for Canada to change track and try to start building relationships with other countries, other trade partners. And they've actually done a pretty better job than I was expecting.
Really?
Yeah, they've much faster than I expected it to happen, which is great. That's actually, I think it's a good thing for for Canada long term. I always said when I would be meeting with clients and they'd ask me, what do you think this means? Long term, I actually think it's kind of a good thing.
I remember you saying that when
Yeah.
you were like, the tariff don't necessarily mean it's a bad thing,
It kind of sucks in the short term, but
but in long term, it's could be a good
diversifying,
thing.
I mean, like literally everything that I teach with investing is kind of like the same thing in a lot of areas, and diversifying your trade partners, diversifying trade routes, like that can't be a bad thing. Like how could that possibly be a bad thing for Canada long term? So
Right.
yeah, I don't hate it.
Or building stuff in Canada.
Yeah.
Like, didn't you say that could be
Yeah.
a possibility? We have a
100%.
lot of
It doesn't
lands.
happen overnight, but yeah, I think there's short term pain for long term gain. Yeah, I don't think it's a
Just
bad thing.
possibilities.
Yeah. The US is flat pretty much year to date. This is actually a really which we'll get to, but now I'll keep going and then we'll circle back to it. The developed markets, so that's outside of Canada and the US, but this is like Europe and other very developed markets. That's up 14%. It's actually done very well, which we expected. That's as expected for the beginning of the year. And emerging markets is up 9%, and that's pretty much done as expected. They're the countries that are growing, like India, Brazil, things like that. Like they don't have a fully developed economy, but they're doing well. So
Yep.
yeah, they over the long term they have underperformed the US. The US has been the best performing market in the world for the last 50 years, pretty much.
That doesn't surprise me considering maybe I shouldn't bring this up when we were talking about like the mat leaves and stuff and how the US like I want to say Western culture, but it really is in the States hardcore where because I'm on mat leave right now, that's on my mind. And yeah, their mat leave is super short.
As I say, I would never bet against an economy that prioritizes somebody getting back to the workforce over, I think, 6 weeks they get at the most,
Something
and it's like a
that.
disability leave.
It's
crazy.
great. Now that I've been through it, wow,
Yeah,
unbelievable.
very quick turnaround. Yeah, pop them out, get back to work right now.
Yeah.
It's crazy. So yeah, that's kind of what the markets have performed. Something I mentioned in the video that I want to go through is there are different parts that we can attribute returns to in the markets. So people think that the market returns are market returns, and a lot of people don't understand all that goes into returns. So there are 4 key areas. There's something called multiple expansion. There's earnings growth, there's dividends, and then there's currency.
Mm-hmm.
What do you think? I don't actually expect you to know this.
I'm like,
What do you think?
Please don't ask this question.
Multiple expansion is?
Thanks for starting off nice and easy. Multiple expansion. Okay, I think it's expanding into other markets.
Okay, that's great. Yeah, that's why not. Okay, so it's when we value a stock, we do it by, like, let's say, if I earn $100, maybe I value the company at a multiple of that earnings. So
The potential of it, kind of.
no, not quite. So yeah, this might be a little hard to understand. So let me give my best shot. So let's say I have a lemonade stand and I do $1 of revenue. If that lemonade stand is trading at a 10 times multiple of earnings, that lemonade stand is worth $10 because I earn $1 from it, or the lemonade stand earns $1, 10 times multiples. So it's price to earnings. So it'd be, if the lemonade stand was worth $10, it would be a 10 times multiple.
Okay.
Okay. If it was a 20 times multiple, how much would that lemonade stand be worth?
$20.
Okay. 100 times multiple, how much would it be worth?
$100.
Okay. So who decides that multiple?
Don't know.
The markets, the
Okay.
general, kind of like a voting system. Okay. So has that lemonade stand really changed if the multiple is $20 versus $10?
Yes.
How's the lemonade stand? The
Oh,
actual,
the stand itself
Yeah.
hasn't changed, I guess.
No,
The
nothing's
business is the same unless
exactly. So, but it's just us assigning more value, more worth to that business. So that's what multiple expansion is. And that happens for a wide variety of reasons. But typically it's because expectations are high for the future of that lemonade stand. Okay. So same example, let's say it normally is 10x. So normally it's worth $10, but we think that this lemonade stand, you know, they sell the best lemonade stand in the world, the best
lemonade
lemonade
stand.
best lemonade in the world, and we expect them to do $10 of revenue next year. Well, we might assign a higher multiple to that lemonade stand because we think it's going to do 10 times the revenue next year. So we may say, okay, maybe it is worth 20 times the current revenue, right?
Right.
So that's
Is
multiple
this
expansion.
a valuation? Okay,
Yeah,
sorry, you know what I'm thinking of? Shark Tank.
but yes, but that's that. Yes, very yes. Actually, Shark Tank's done a lot to improve people's financial literacy.
Yeah,
Honestly, more than
I
but
love
correct.
that show.
That's multiple expansion. Okay, earnings growth. What do you think that is using the lemonade stand?
Like revenue, I would think.
Yeah.
Like,
So if it's trading at 10x, let's say, so that $1 of revenue, company's worth $10, and that company goes to $2 of revenue, what's the company now worth? $20. Okay. Like it's doubled its revenue, it's doubled the valuation. It's still trading at a 10x multiple. Okay.
yep.
If it goes to $10 of revenue and it's still trading at a 10x multiple, it's now worth $100. Okay. So that's one way that the markets go up is companies just earn more, but the multiples stay the same. Then there's dividends. So dividends are that $1 lemonade stand pays out 10 cents to people who own it. That's a return that causes the markets to go up to a degree. There's a caveat to that, but that is part of a return that somebody would get from the markets.
But not every stock has dividends.
No, and I'm not going to get into dividends because,
Okay.
yeah, that's
I'm like, I know I know a little bit about dividends, but I was like, yeah. Anyways,
yeah, just fundamentally making it's a huge topic. Dividends tend to be overvalued in people's heads because when you look at stocks, you'll notice that they go down by the same amount or similar amount to their dividend because it's really just another form of paying. It's priced in. So people overvalue dividends, but that's another point. Okay, and the last one is currency. Okay, how do you think this would impact somebody's return?
just like how the currency that's being used for the business is doing overall, I'm guessing, like
In relation to what?
the globe.
Kind of, yeah. So let's say this lemonade stand is in the US and it's US dollars,
Yep.
right? And the US dollar weakens against the Canadian dollar. So let's say, it was $1.30 of Canadian dollars to $1 of US dollars, like roughly what it is now. And it was suddenly $1 to $1. So for suddenly our Canadian dollar was really strong against the US dollar. Would that lemonade stand be worth more or less to Canadians?
It would be worth less.
Yeah, right. So, and the vice versa is also true. If the currency gets stronger, then it's worth more. And what we saw over the last year or so is a lot of the return, because the returns have been good, but a lot of them have been caused by multiple expansion and currency. So that's not a great sign for the US because it means the US dollar is weakening
Oh.
against a lot of other currencies. And it's not a great sign for us as, like, for example, in the in the US, in China, even in emerging markets where chunks of it were just people expanding what they were willing to pay for that same company. And that's always concerning because if growth doesn't meet expectations, there's a lot more room for it to drop before it gets back to what we consider fair market value, like a fair historically normal multiple value. So if lemonade stands were normally trading at 10x and suddenly they were up to 30x, and maybe you think that the company's going to grow their revenue, but then if they don't and they go back and they just think, oh, well, it's just a normal lemonade stand which trades at 10x, it means that the stock goes from $30 at 30x back down to $10 at 10x. But the company hasn't changed. The company's fundamentally still the same company, but because it doesn't live up to expectations, the price drops. Doesn't mean it's a bad company.
Yeah.
It means that the price was expensive when you bought it. You bought something that was expensive. So right now, stock market is on the or certain parts of the stock market are more expensive.
So would this be like during COVID where I remember certain stocks were getting like blowing up, like Disney and like Zoom. And then there was those like weird, like, what do they call them? Meme stocks, Dogecoin and stuff. It's like, is that, maybe I'm wrong. Sorry. I don't know if that's.
Kind of, yeah. But that's in essence, that is what happened like with Zoom. Have I ever showed you the Zoom stock?
I don't think so.
Okay, let me bring it up and show you Zoom stock. Yeah, you know there's something wrong about this graph here.
That's exactly what I thought it was going to do. But that must be so that's what you're saying though. It's like everyone got crazy and was like, Zoom is the future. Like I mean, yeah, everybody still uses Zoom, but it's not worth what we made it.
Exactly, right?
Worth.
So you see just below, this is on Google, it says in the middle column, it says P/E ratio.
Mm-hmm.
So that's price to earnings ratio. So that's kind of one of those multiples. There's others, but that's one of the multiples that I was talking about. So it says 22 right now.
Yeah.
At the height, the company was the same, but it was like, I think it was like at 500.
Oh my goodness.
Like it was overvalued, right? Like they were hoping that it would do these crazy things, and then reality hit, and even it could still be a good company. Doesn't matter if you paid too much for it, right? So that's kind of where that's the cautionary tale for the markets right now. Doesn't mean that you use that information to trade on,
right?
But what I would say is it's another reason why it's really important to try to avoid lump sum investing as much as you can, right? And why I say instead of trying to invest money, like big lump sums where you have to make a decision, and in essence you're trying to time the market. That's why it's much better to put in a good amount every opportunity that you have, so that you don't get caught up in a scenario like this, because people might have been sitting on the sidelines and they saw the big drop, and they're thinking to themselves, oh, maybe it might go back, maybe it might go down. And then the recovery was only 2 weeks, and now you miss your opportunity. Well, now do you buy? Well, the markets have just went up since then. Do you buy now? Well, it's now expensive. Like it's so many decisions and kind of.
And you have no information of what the future is going to be.
No. And while we know that the markets are expensive, doesn't mean that companies won't earn more to make it worth it. Mm-hmm. Right. And then it never comes back. There's plenty of levels where it's been all-time highs and we've never seen markets drop below that again. Yeah. Right. So just an important thing to keep in mind. But yeah, so that's the biggest things that I kind of wanted to go through about the quarter. Honestly, even though it's been kind of choppy up and down, I think I think overall, considering the markets have been markets, I don't know, hasn't been anything to write home about. We'll remember the drop in April, but aside from that, we won't remember May, June. We'll see about July, but we're not going to remember the months as anything special. And it's really on the eyes are on politics. It's not really even on economic side of things. Inflation is still kind of up, higher than we'd want it to be. Something I touched on here is that during that annual review, my video, when inflation, like when people often think that inflation numbers mean like as they get lower, that the prices are going to come down.
Mm-hmm.
And I was explaining that that's not the case at all. So
What?
when outrageous.
I don't like that.
Yeah, it just means that prices are going to go up less. So if you think of it as I have $100 and prices go up 10%, everything now costs $110. But now if prices only go up 5%, well, it's not like prices go back down to $105. It's that now prices at 110 plus 5%, 120,
I just want to say
116%, something 116%, I think. Something like that. I can't do the math off the top of my head. Around that. So but prices are still going up. So I think people do, if you're there hoping that things are going to get more affordable, the solution is not to hope things are going to get more affordable. The solution is you need to figure out a way to increase your own personal income or spend less, make other decisions, because it's very unlikely that prices are just suddenly going to come down back to what they were pre-COVID.
Ugh.
And even more so for Saskatchewan is that we still have some of the most affordable living in Canada. So if we think it's expensive here, it can get a whole lot worse.
Yeah. Ooh,
So
I don't like that.
yeah, sucks. But you go to anywhere else, you'll find houses more expensive. You'll find it more expensive to live life, and that's the good thing about Saskatchewan. There's the winters, cold, sucks, but it is affordable compared to other places in Canada for sure. Not compared. There's some places obviously in the world that are significantly cheaper, but
In Canada.
So anyway, any questions for me for that?
I don't think so. I kind of I would answer your question, then you'd explain it because I was wrong on most of them. But
That's okay. That's good. Okay, perfect. Well, we will leave it there, and I think so we'll do these type of episodes will be like special episodes, so they won't be officially like numbered or anything. I'll let us keep track on everything else, but so I guess this will be a bonus podcast episode
for sure.
But anyway, perfect. We will see you in the next one.
Bye.
Bye. Thanks for listening to this episode of the Plain English Finance Podcast. Trey Bino, Certified Financial Planner, Chartered Investment Manager, is a financial planner with TC Wealth Management and Aviso Wealth. You should always consult with your financial, legal, and tax advisors before making changes. This podcast is provided as a general source of information and should not be considered personal investment advice or solicitation to buy or sell any securities. The views expressed are those of the individual and are not necessarily those of Aviso Financial Inc. Mutual funds and other securities offered through Aviso Wealth, a division of Aviso Financial Inc.